Among the 24 unbreakable laws that William Delbert Gann forged over a lifetime of market study, there is one that stands as the great dividing line between the professional and the amateur. It is a rule so fundamental yet so frequently and disastrously violated that he labeled it one of the worst mistakes a trader can make. This is his 13th rule: never average a loss. This single simple command is not merely a piece of trading advice. It is a profound lesson in psychology, risk management, and the brutal realities of the market. To average a loss is not a strategy. It is the symptom of a deep and fatal psychological flaw, an act of arguing with the undeniable truth of the tape. It is a decision born not of analysis but of hope and ego. William Delbert Gann identified this practice as the surest way to lose all or a great part of your capital, the most direct path to financial ruin a trader can take. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. To understand why this flaw is so fatal, we must first dissect the anatomy of the mistake. The process begins the moment a trade moves against you. You have conducted your analysis, you have acted on your rules, and you have entered the market with the expectation of a profit. But the market, in its cold and impartial judgment, moves in the opposite direction. At this critical juncture, you receive the most valuable piece of feedback a trader can get. The market is telling you that your judgment at that specific time and price was wrong. In his characteristically direct manner, William Delbert Gann stated this plainly: if you make one trade and it starts to go against you, you are wrong. This is not an opinion. It is a fact recorded on the tape. The professional accepts this fact immediately. The amateur, however, does not. It is here that the fatal flaw takes root. The decision to average a loss is, first and foremost, an act of ego. It is a refusal to admit a mistake. The trader's ego cannot accept the market's verdict. Instead of concluding, "My analysis was incorrect," he concludes, "The market is temporarily wrong and I am still right." The falling price, which is clear evidence of his error, is perversely reinterpreted by his ego as an opportunity. He sees the lower price not as a warning sign but as a bargain, a chance to buy more of the stock he believed was a good buy at a higher price. This is a catastrophic failure of logic. He is not making a new objective decision based on the current market action. He is stubbornly reinforcing his original and now proven mistake. He is committing more of his precious capital not to a winning position, but to a losing one, in a desperate attempt to prove his initial judgment correct. This act of ego is fueled by the single most destructive emotion a trader can possess: hope. William Delbert Gann warned relentlessly against the dangers of this emotion, stating, "Hope will ruin any man who follows it in the stock market." To succeed, you must face facts. When a trader averages a loss, he has completely abandoned the world of facts and rules and has entered the fantasy realm of hope. He hopes the stock will stop going down. He hopes it will reverse. He hopes the market will eventually vindicate his decision and save him from his growing loss. He is no longer trading the market as it is, but as he wishes it to be. He has, as William Delbert Gann described it, begun to follow the fairy phantom of hope in Wall Street trading. This progression is as predictable as it is destructive. The initial small loss, which could have been easily handled, is now a larger, more worrisome loss on a bigger position. The trader's anxiety increases, but so does his commitment. He is now financially and psychologically married to the trade. His judgment becomes completely compromised. He will ignore all further evidence that his position is wrong. Bearish news will be dismissed, and any minor, meaningless rally will be seized upon as proof that the final turn has come. He is no longer an analyst. He is a believer. This is the psychological trap of averaging a loss. It begins with a small act of ego, is fueled by a desperate hope, and ends with the trader's judgment being so hopelessly warped that he is incapable of making a rational decision to save himself. This fatal progression highlights the stark contrast between the mindset of the professional and that of the amateur. When a trade moves against him, the amateur's first impulse is to seek external validation for his original idea. He will read only the bullish news articles, listen only to the optimistic commentators, and see the declining price as an increasingly attractive bargain. His every action is geared toward reinforcing his initial mistake. His response to a losing position is to increase his risk, to commit more capital to a failing enterprise. William Delbert Gann described this mindset perfectly. When a man is long or short of the market and has a loss, it is but human nature to hope that the trade will go his way. The amateur follows human nature, and it leads him to ruin. The professional, in contrast, has trained himself to act against human nature. When a trade moves against him, his first impulse is not to reinforce his opinion, but to question it. The market's adverse movement is a factual signal that his premise is, at least for the moment, incorrect. His primary objective is not to be proven right, but to protect his capital. His response to a losing trade is to immediately and mechanically reduce or eliminate his risk. He does this by adhering to a predetermined stop-loss order, a rule-based decision made before his judgment was clouded by the emotions of a live position. He wrote, "When you make a trade, you can be wrong. Then you must know what to do to correct your mistake. The way to do that is to limit your risk by placing a stop-loss order. The amateur is focused on the profit he hopes to make. The professional is focused on the loss he knows he must prevent. The amateur sees a losing trade as a challenge to his ego. The professional sees it as a simple business expense, an error to be corrected as quickly and cheaply as possible. He knows that his capital is his lifeblood, and the preservation of that capital is his single most important job. By cutting the loss short, he not only protects his account, but he also clears his mind, allowing him to step back, reevaluate the market with an unbiased eye, and wait for the next genuine opportunity. The amateur, by feeding his losing position, becomes a prisoner to a single trade, his judgment and his capital slowly bleeding away. This is the great dividing line. The professional cuts his losses. The amateur averages them. And in that single decisive difference in action lies the gulf between success and failure. The psychological flaws of ego and hope are the seeds of a trader's destruction. But these seeds need fertile ground in which to grow, and they find it in the seemingly logical but mathematically disastrous strategy known as buying on a scale, or, as it is more commonly called, averaging a loss. While the first part of this analysis focused on the flawed mindset that leads a trader down this path, we will now dissect the mechanics of the strategy itself. We will explore the direct and unwavering attack that William Delbert Gann launched against this practice, and we will examine, with cold, hard arithmetic, the mathematical certainty of ruin that it creates. It is one thing to understand that averaging a loss is psychologically damaging. It is another to prove that it is, in fact, a mathematical trap with no escape. William Delbert Gann dedicated a specific section of his masterwork, Truth of the Stock Tape, to dismantling this very practice. His condemnation was absolute. He stated, "I have never yet seen a scale method that would beat the market." He saw it not as a strategy for the astute investor, but as a fool's errand. A method so dangerous that only the wealthiest men in the world could even attempt it, and they were wise enough not to. He powerfully reinforced this point by citing the legendary financier Russell Sage, who, when asked if he believed in buying on a scale, replied that there were only 3 men who had money enough to buy on a scale: Carnegie, Morgan, and Rockefeller, and they had more sense than to do it. The fundamental reason why this method is doomed to fail is that it violates the most basic principle of risk management. William Delbert Gann explained the flaw with stark simplicity. You add to your holdings when the market is going against you, thus increasing your risk. Think about this for a moment. The market, through its price action, is providing you with clear, factual evidence that your initial judgment was wrong. The stock you bought, which you believed would go up, is going down. The trend is moving against you. The logical professional response is to heed this evidence and reduce or eliminate your risk. But the trader who buys on a scale does the exact opposite. At the very moment the market is proving him wrong, he decides to increase his risk by committing more capital to his failing position. He is, as William Delbert Gann described it, doing his best to make a bad situation worse. The allure of this method is the siren song of a lower average price. The trader tells himself he is improving his position. But this is an illusion. While his average price per share may be lower, his total dollar risk has ballooned. He has transformed a small, manageable mistake into a large and potentially catastrophic financial commitment. William Delbert Gann contrasted this with the professional's approach, stating, "The time to take additional risk is when the market is moving in your favor, as shown in my pyramiding plan. This is the great dividing line. The professional adds to a position when the market is proving him right. The amateur adds to a position when the market is proving him wrong. One is a strategy of strength and confirmation. The other is a strategy of hope and self-deception." To fully comprehend the destructive power of this fatal flaw, let us move from the theoretical to the practical and examine the mathematics of ruin. Imagine a trader whom we will call the amateur, who has $10,000 in his account. He has identified a stock trading at $50 that he believes is poised for a major advance. He decides to buy 100 shares, a commitment of $5,000. He feels confident and does not set a protective stop-loss order. The stock, however, does not advance. It begins to decline. It soon reaches $45 a share, a 5-point loss. His position now shows a paper loss of $500. Instead of accepting the mistake, his ego takes over. He tells himself, "If it was a good buy at $50, it's an even better bargain at $45. He decides to average down. He buys another 100 shares at $45, a new commitment of $4,500. Let us pause and analyze his new position. He now holds 200 shares. His total cost is $5,000 plus $4,500, which equals $9,500. His average price per share is now $47.50. He feels a momentary sense of relief, having improved his average cost. But what has he actually done? He has now committed $9,500 of his $10,000 account to a single stock that is actively moving against him. His risk has nearly doubled. The stock continues to fall. It drops to $40. His position of 200 shares with an average cost of $47.50 now shows a loss of $7.50 per share for a total paper loss of $1,500. His $10,000 account has shrunk to $8,500. Panic begins to set in, but it is mixed with a stubborn refusal to accept such a large loss. He decides he must bring his average cost down even more. He scrapes together his remaining capital and buys 200 more shares at $40, a commitment of $8,000. Let us again analyze his position. He now holds a total of 400 shares. His total cost is $9,500 plus $8,000, which equals $17,500. His new average price is approximately $43.75. He has now committed capital far in excess of his initial account balance, placing him on a heavy margin. His exposure is no longer just a trade. It is an account-threatening gamble. The stock now only needs to decline a few more points to trigger a margin call and wipe him out completely. He started with a single, manageable mistake and, through the destructive mathematics of averaging down, has guided himself to the brink of financial ruin. Now, let us contrast this with the professional, who also starts with a $10,000 account and follows the unbreakable laws of William Delbert Gann. He, too, identifies the same stock and buys 100 shares at $50. However, his very first action after entering the trade is to place a protective stop-loss order at $47, a predetermined risk of 3 points, or $300. This represents just 3% of his capital, well within the conservative guidelines. The stock begins to decline. It hits $47. His stop-loss order is executed automatically. The trade is over. His loss is $300 plus commissions. His account now stands at $9,700. He does not feel panic. He does not feel the need to be vindicated. He feels nothing, because this was a pre-planned business expense. His mind is clear, and his capital is almost entirely intact. He waits patiently for the next opportunity. A week later, he identifies another setup in a different stock, this time buying at $60 with a stop-loss at $57. This trade moves in his favor. It rallies to $75. Following Gann's rules, he lets his profit run, protected by a trailing stop-loss. He exits the trade with a 15-point profit, or $1,500. His account now stands at $11,200, $9,700 plus $1,500. The single winning trade has not only erased the small, controlled loss from his first mistake, but has resulted in a substantial net gain. The mathematics are as undeniable as they are powerful. The amateur, by averaging his loss, created a geometric progression of risk that led to ruin. The professional, by cutting his loss short, treated it as a small arithmetic business expense that was easily overcome by a single profitable operation. Applying these strategic rules with a master's precision requires the ability to grasp the dynamics behind every price movement. William Delbert Gann's Truth of the Stock Tape is the foundational guide for this skill. It's not a book of theory, it's a practical course that teaches the reader to understand the real-time contest between buyers and sellers, recognize the critical phases of accumulation and distribution, and assess a trend's true strength. This edition is a faithful reproduction of the 1923 original. The historical charts from that 100-year-old publication are included. While many are difficult to read, their inclusion was deemed important for historical context. The true timeless value, however, lies in Gann's text. For any serious student ready to understand the market's real intent, this book is an essential resource. Get your copy via the link in this video's description. Having established the destructive psychology and the ruinous mathematics behind the fatal flaw of averaging a loss, we now turn to the professional's alternative. It is not enough to simply know what not to do. A successful trader must possess a clear, mechanical, and disciplined procedure for what he will do when a trade moves against him, and, just as importantly, what he will do when a trade moves powerfully in his favor. William Delbert Gann did not just condemn the amateur's mistakes. He provided a complete, logical, and profitable alternative. This is the constructive side of his 13th rule: the art of cutting losses without hesitation and the science of compounding profits through professional pyramiding. This is the method that replaces the hope of the gambler with the strategy of the business owner. The correct professional response to a losing trade is not to add to it, but to eliminate it. The mechanism for this is the stop-loss order. As we have discussed, this is the second of the 24 unbreakable laws, but its true power is realized when it is understood as the direct antidote to the temptation of averaging down. The decision to place a stop-loss is a rational act, performed in a state of calm objectivity before a trade is ever entered. It is a pre-commitment to discipline. It is the trader's admission to himself that his judgment can be wrong and his plan for exactly how he will rectify the mistake when it occurs. When the price moves against the position and triggers the stop-loss order, the decision is taken out of the trader's hands. There is no room for debate, no time for hope to creep in, and no opportunity for ego to defend its mistake. The action is mechanical and final. The loss is cut short and the mistake is corrected. William Delbert Gann viewed this as an act of wisdom. He wrote, "Once you have placed a stop, you have acted wisely and used good judgment. To change your mind from this decision is foolish. It is not based on good judgment but on hope, and hope can lead to nothing but losses in Wall Street. The trader who is stopped out of a losing position has not failed. He has successfully executed a critical part of his business plan. He has paid a small, controlled business expense to the market, and in doing so has preserved the two assets that are essential for his long-term success: his capital and his mental clarity. His mind is now free to analyze the market anew, unburdened by a losing position, and ready for the next genuine opportunity. This leads to the great and powerful alternative to averaging a loss: the professional technique of pyramiding profits. This is the core of the offensive strategy, the method for transforming a good trade into a great one. The foundational principle is the polar opposite of averaging down. William Delbert Gann stated it with perfect clarity. The time to increase buying is when the market is moving in your favor and you have a profit. You do not add to a position that is proving you wrong. You add to a position only after the market has proven you right. The logic of pyramiding is the logic of a sound business. Imagine a general on a battlefield. He does not send his main reinforcements into a losing skirmish. He waits until his forces have achieved a decisive breakthrough, and then he sends his reserves to exploit the weakness in the enemy's line and press the advantage. The trader must act with the same strategic sense. Your initial trade is your scouting party. You risk a small, controlled amount of your capital. Only after that initial position has proven successful, by moving in your favor and creating a profit, have you established a breakthrough. It is at this point, and only at this point, that you should consider committing more capital. William Delbert Gann taught several methodical ways to pyramid a position. One method is to add to the trade after it has decisively crossed a major resistance level. He wrote, "Wait until the stock is very active and has crossed resistance levels before buying more." This ensures that you are adding to your position at a point of confirmed technical strength, just as the stock is entering a new phase of its advance. Another, more conservative method is to add to your position on the normal, healthy reactions that occur within a strong, established trend. He explained in Truth of the Stock tape that a trader can determine the reaction levels of a stock, whether its normal pullbacks are 3, 5, 7, or 10 points, and then buy or sell your first, second, third, or fourth lot for pyramiding on reactions from the top. This allows the trader to add to his core position at successively higher but temporarily lower prices within the main uptrend. Let us now directly contrast the path of the professional who pyramids with the path of the amateur who averages a loss. The amateur who buys a stock at $50 and sees it drop to $45 buys more. He is adding capital to a position that is losing him money. He is increasing his risk on a premise that has been proven wrong by the market. His total financial exposure grows while his account equity shrinks. He is actively fighting the trend. The professional, on the other hand, who buys a stock at $50 that rallies to $60, might decide to buy more on a reaction to $57. He is adding to a position that is making him money. He is increasing his exposure on a premise that has been proven correct by the market. He is, in effect, using the market's own money, his paper profits, to finance his increased position. His risk on the new capital is offset by the cushion of his existing profit. He's trading in perfect harmony with the trend. The amateur feeds his losses, hoping for a recovery. The professional feeds his winners, confident in their strength. The 13th rule of William Delbert Gann, never average a loss, is far more than a simple piece of advice. It is the great dividing line between the professional and the amateur, between the scientific speculator and the hopeful gambler. It is a profound test of discipline, ego, and one's entire approach to the market. The amateur, driven by a fragile ego and the destructive emotion of hope, cannot bear to admit a mistake. He sees a declining price as a personal affront and a chance to prove the market wrong, and so he averages down, feeding good money after bad until his account is destroyed. He has committed, as William Delbert Gann warned, financial suicide. The professional, in stark contrast, has built his entire business on the foundation of accepting and managing mistakes. He understands that a small loss is not a failure, but a necessary and routine business expense. His response to a losing trade is mechanical, unemotional, and immediate. He cuts it short. He then turns his attention to his winning positions. He does not add to his losers. He adds to his winners. He methodically pyramids his profits, pressing his advantage only when the market has confirmed that he is on the right side of the trend. The amateur feeds his losses. The professional feeds his profits. In that single fundamental distinction lies the entire secret to long-term survival and success. To reject the fatal flaw of averaging a loss is the most significant step a trader can take. It is the decision to abandon the casino and to begin, at last, to operate as a professional, following the unbreakable laws laid down by William Delbert Gann for making speculation a profitable profession.